All right, welcome back. In the last couple of videos I recorded, I really set up the challenge of modeling growth. And I want to head towards solving that problem. In fact, I'll have several videos where we talk about growth, specifically sort of the sources of growth and how to model growth. But I do want to backtrack for a moment. And in this video, I'm going to set up the discussion of competition. And we do have to talk about competition before we talk about growth. And competition will be a series of videos related to this topic, because if, in fact, the business is vulnerable to competition, then it's hard to value the business, or although you could argue it will always be worth less than what it is. But if we can't establish that there are some barriers to entry against competition, then the growth won't matter. I'll flesh that idea out significantly more over the next couple of videos. But I want to just step back for a moment, set the stage for the next couple of videos where I talk about the threat of competition. Once I'm done with that, that will set us up for a full discussion on barriers to entry and effectively competitive advantage, ultimately discussing and defining sustainable competitive advantage. But what I want to do is link the challenges of valuation to the beginning of competitive threat. And I'll do that over a series of a couple of videos, starting with this video. All right, the way we set this up, the challenge of modeling and valuing growth was, this is the company, this is their yearly NOPAT. As a reminder, NOPAT is really my measure of owner's earnings. It's a cleaned up net income, if you will. It's really truly the cash the business has generated. And in this example, we have the company growing each year. This is a steady growth rate to make life easy. And I said, this is ultimately the challenge, the valuation challenge. I call it the DCF challenge, but it really is the valuation challenge. How do you value a business that's growing? Even if it's a modest growth rate, 1 or 2 or 3%, or significantly more growth rate, 10 or 15, maybe even more, it all ends up being roughly the same issue. And so the first hack that we come up with is, let's split the business, if you will, into two components. One component will be a steady state set of cash flows. The other will be growing cash flow. And through some very simple, straightforward logic, we can show that valuing the steady state business is fairly straightforward. And then that puts the burden on valuing the growth. And that's what I talked about at the end of the last video, which is the challenge of valuing growth. But I want to go back for a moment and just make sure we're tying a few loose ends related to valuing blue. You'll hear me say, as I move forward in videos, blue, that represents your steady state, no growth value. Green is your growth value. So you'll hear me slip into my discussion blue and green. Blue is that steady state, no growth, NOPAT lasts effectively forever. And then we value growth, green, on top of that. Now I want to go back to blue for a minute. And this video is really going to be focused on blue and the beginning of, just really the launch of thinking about competitive threat. All right, so we stop what we said is, if we assume that the company earns the same amount of money every year forever, we can value that business. Fairly straightforward. Now, in the real world, there's sort of two natural concerns you'd have. Number one is, we're not suggesting that they earn the same exact amount dollar for dollar every year. It's just the idea about a certain amount that they'll earn every year. That's your base level. It is what you think is that steady state, what the company is going to be able to earn into the foreseeable future. I tend to think of it as kind of a 10-year forecast, even though we're modeling it forever. I don't think the stock market looks much beyond, in this case, much beyond 10 years. I think 10, you're in good shape. So the question you ask yourself is, what do I think this business can earn, knowing what we know today, for the next 10 years, sort of as a base level. And then we'll add growth to that. So those are sort of the two things you want to think about. It's not an exact amount each year. It's a base level amount, may bounce around a little bit each year, probably will bounce around each year. Even the most stable businesses bounce around each year. And then, although we're modeling this as a cash flow forever, earnings forever, kind of thinking, 5 to 10 years out, I think this level of the business would be fairly stable. And then we'll add growth on top of that. Now, the other pushback I get often is that people say, I'm not comfortable forecasting 10 years. And yet, and we did talk about this, and I talked about this in the last video, anytime you use a multiple, whether it's a PE multiple or an EBITDA multiple or any kind of multiple, price to revenues multiple, you're effectively forecasting forever. And I think people don't always appreciate that when they're using a PE, simple shorthand on Wall Street, or in the private equity investment banking world, they often think about EBITDA multiples. Those multiples are implying essentially a base level of cash flow or earnings that last forever. That's what's implicit in using a multiple of any kind. So we're not really changing that assumption at all. We're just making it more explicit. And maybe because we're making it more explicit, that makes some people a little less comfortable. But the assumption is there nonetheless. All right, and because we assume no growth for that base level, that earnings power value, that area which I will color in blue and will always color in blue, we just assume NOPAT 1 equals NOPAT 2, NOPAT 3, all the way out into forever. Yeah, I'm thinking 10 years is my forecast period, but I'm modeling essentially forever. Well, the nice part is that that's a perpetuity. We can use the perpetuity valuation formula, which is nothing more than capitalizing the NOPAT divided by your discount rate, and that's the value of the stock. And I think that's kind of a cool place to land, which is we know how to value a steady state, no growth company. Come up with what you think that annual, high probability, high confidence net income cash flow, and then you can value that with your discount rate. It's pretty straightforward. Now, of course, that then means we have to value growth. And there's no question that is the harder of the two exercises. But I like splitting it so I know, hey, what's this business worth if it didn't really grow? And then how do I value that growth on top of it? Now, we're going to come to that problem, although we have to do a few things beforehand. By the way, to some degree, that's what Buffett does, best we can tell. He pays 10 times-ish a cash flow he's very comfortable with. And then story has it, I've obviously never been in part of his negotiation, he gets the rest of the business for free. So he's effectively not paying for growth. So growth is free. It's a free option. It's also his margin of safety is growth. So if he can convince the owner to sell at 10 times what he thinks is that steady state, no growth, NOPAT, or he uses owner's earnings, then he's effectively earnings power value. That's what he's paying for. He's getting everything else for free. He's getting green for free. So again, that's both his margin of safety as well as his upside. He gets all of that for free. He's not paying for it, so he gets it for free. Pretty cool. All right, so our no growth, steady state, earnings power value is just NOPAT capitalized, that NOPAT you're comfortable with, which is pretty cool. All right, and then we define that as your earnings power value, EPV, which is pretty cool. Some quick graphics. There's your NOPAT. There's your earnings power. Flip that outside the chart. Duration is sort of forever, although you could think here 10 years. And so that's your earnings power value. Visualize. It's your earnings power times the duration, which is effectively that equation. All right. I'm covering ground I already covered in the prior video, but I wanted to set this up because one thing that's really important to recognize is we're assuming that steady state earnings power. Right? We just walked through it, that 10-year sort of forecast. So the question becomes, if a company's profitable and doing well, that's going to attract competition, right? So it assumes that NOPAT 1 equals NOPAT 2 equals NOPAT 3 equals NOPAT infinity, out to infinity. And I get this nice little formula, earnings power value. But the question I ask is, will a positive NOPAT attract competition? because I'm making the assumption, and we need to make the assumption in our valuation, the model we're using, that NOPAT's going to be steady for each year for, call it 10 years. It doesn't have to be perfectly steady, but it's going to be in a fairly tight range. I'm comfortable with that estimate. But if that is going to attract competition, that positive NOPAT is going to attract competition, then I have a problem. I really do have to think about barriers to entry, competitive advantage, and ultimately sustainable competitive advantage, which I'm going to get to. But we actually we need to talk a little bit about how competitors think about entering markets. And that's what I really want to set up in this video. All right. So if competitive pressures drive profits lower, then we can't use the formula. Now we have a problem, right? So the assumption of using the formula is that this level of earnings, what I'm calling earnings power, this level of NOPAT, is going to be steady for, again, I repeat myself a couple of times, maybe 5 to 10 years. But if that positive NOPAT is going to attract competition and they'll drive down that level of profitability, I no longer can assume steady state. NOPAT 1 and NOPAT 2 and NOPAT 3 don't equal each other. In fact, future NOPAT's going to be lower because of those competitive pressures. I no longer have a steady state stream of cash flows. I no longer can use that perpetuity formula. And now all of a sudden calculating earnings power value is much more challenging because I have a declining cash flow, not a steady cash flow. So that's why we really talk about, will a positive NOPAT attract competition? Because if it does, all bets are off. So this is starting to set up the case for barriers to entry, competitive advantage, and then ultimately sustainable competitive advantage. But I want to talk a little bit about what the competition's thinking about. So if it's not steady state, I can't use that formula. All right. I have to introduce another concept, which I think a lot of people would be very familiar with, which is the return on invested capital. This could become an important measure as we talk about barriers to entry and competition, for sure, ultimately a sustainable competitive advantage. All right, defined, very easy. There's a lot of good material on the web on return on invested capital. I'm not going to go into much detail of that, but it's a return measure. So I invest a certain amount of capital, and then I expect that capital will generate cash. That's why I've made the investment. So if one of your competitors is looking at your business and thinking that that might be an interesting business to enter, they have to think about their potential return. Now, there are irrational business people on the planet. I agree. But we have to assume to some degree that business person leading the investment decision is going to think about their ultimate return. That measure will be return on invested capital. Your invested capital is net working capital plus net property, plant, and equipment. The competitor has to invest if they are going to enter the business, but if they're and then they have to be concerned about their potential return, and NOPAT would be the return. Now, it takes a little while to scale the investment, the new business, but this is ultimately the measure. All right, so entering new markets is not free. If a competitor decides that you're in a nifty business and they want to enter that business to compete with you, they have to invest money up front, probably some property, plant, and equipment, hire some employees, perhaps have some working capital to get the business running. They have to make that investment up front. Rational business people probably won't make that investment unless they think the ultimate return on that investment will generate a return greater than their cost of capital. So if the CEO of a competitor is thinking about coming after your NOPAT, that's how we set this up. They very much have to think about how much will they have to invest to enter the business, and then ultimately what kind of return could they expect to get from that investment. That's what I want to set up in this video. And then I'm going to walk through a couple of use cases to make that point in the next couple of videos, right? So entering a new market always starts with the balance sheet. We tend to think of income statements. We tend to think about cash flow. We value cash flow, but entering a new business always starts with a balance sheet. They have to invest before they can enter the market. All right, and invested capital obviously becomes a critical component. How much do I have to invest to enter that business? What do I think my profitability will be? And ultimately, what do I think my return on that invested capital will be? That's what your competitors are thinking about. So it's not so much will a positive NOPAT attract competition. It's really the opportunity to earn excess returns that's going to attract competition. And as I said a moment ago, in the next couple of videos, I'm going to flesh that out with a couple of cases where a CEO is faced with that investment decision. All right. So what drives competition? Competitors will attempt to enter a market only if they believe they will get a return on their investment greater than the cost of enter that market. That's the key. All right. Therefore, the competitor will attempt to enter the market only if they believe their return on invested capital from the new investment will exceed their cost of capital to enter that new market. And ROIC is going to be the critical measure. All right, so return on invested capital greater than your cost of capital is going to be the filter that a rational CEO will use to decide to enter the market. So it's not a positive NOPAT per se that attracts competition. It is the opportunity to enter a business and earn a return on that investment greater than the cost of entering that investment. In other words, the return on invested capital in the new entrance into this business is greater than their cost of capital. All right, so that's really how I want to set up the next couple of lectures. I just want to get that in place. Starting with the next lecture, I will go through a couple of cases to show how you want to think about this. And then when we're done with that, it's going to take a couple of videos to get through all the comments I want to make. Once we're done with that, that will be the natural setup to think about competitive advantage, barriers to entry, and ultimately sustainable competitive advantage. All right, great. Thanks for listening.